Louis Johnson is a co-CIO at Capital Wealth Advisors. Louis, let's talk a little bit of the macro and some of the setup here. We just heard the case for stocks. We've got a 10-year that seems to be trying to find a bottom around 2%. Should we believe what the move is telling us? A little bit of a bond, not a sell-off, but at least some resilience, I guess, here the last couple of weeks.
Well, good afternoon, Oliver. Thanks again for having me. If you recall from our prior conversations, Oliver, we've had a philosophy about risk management where we've tried to find ideas where we kind of get long the solution rather than try to short the problem. And when we think about bonds, we think that's a wonderful way to kind of express that view of risk management, because U.S. Treasury bonds, of course, are going to pay you an interest rate while you own them. And then what we've seen is when kind of bad things happen in the world, they tend to perform quite well. And even if you look at, say, year to date, the markets have done really well. But frankly, those U.S. Treasury bonds, particularly longer duration ones, have been, wonderful performers. And so we really view that as a great way of risk management. So we haven't really changed our view on the value of treasuries as a late cycle hedge at all, Oliver. We continue to like them.
Okay, so if we are indeed looking at a market, just kind of looking at your notes, Louis, on the back of last week's apparent confirmation of Jay Powell's intentions, I look at your notes and cuts mean a market that is benefiting longer dated treasuries, benefiting gold. My question is, given the run-up in bonds prices coming into last week, the run-up in gold coming into the signaling from the Fed, do we need additional cuts or more beyond July to keep the moves going for both the bond rally and the gold rally?
Well, that's a really good question, Oliver. I mean, clearly the markets have always been very anticipatory in a lot of these asset classes. We believe there's tremendous value still in those two kind of hedge type investments that we like. There's another sector that really has not anticipated rate cuts, we believe, Oliver, and that's the mortgage REIT sector. That's a sector where it's essentially a pool of leveraged mortgage-backed securities that they finance through short-term borrowing. It seems to us that the euro-dollar market is pricing in essentially 100% probability of a rate cut. I would think that those securities are among those that would benefit the most from a decrease in their cost to funding. Certainly, they performed very strongly from 2000 and 2007 during the Fed rate cutting cycle. So while our view is unchanged that we continue to like gold-related investments and treasury-related investments, we really think that the mortgage REIT sector, particularly where we have the highest quality, longer dated portfolios there, are worth investors' time and attention right now.
So far, it seems that the big move in gold and the response was tied to the drop in the dollar we had around the same time that this language started building from the Fed. Do you have to have a view on the direction of the greenback, Louis, to sort of get an insight into where gold is going?
Different people are going to thoughtfully disagree on this, Oliver.
Right.
My experience in the gold markets for a long period of time is that people's first thought really does go back to what the dollar is doing. I think it's very difficult to forecast strength of different, currencies. Gold was around before the dollar was here. It'll be around after the dollar is gone. It's always been my view that, I guess, gold is very much a large elemental force, in the markets across currencies. If you take a look at the big moves that gold has made in the past, it really is kind of irrespective of what happens in the dollar, because these moves take place in all currencies. So, for instance, so the short answer is no. I don't think it's tied to the U.S. dollar in the short run. But if you take a look, Oliver, for instance, gold has hit a new all-time high in Aussie dollars. Gold is moving strongly, in euros, in Chinese renminbi. If we are finding ourselves in a changed world where we have more trade tensions and there's a lot more attention paid to the value of one country's currency relative to that of another, then it would make sense to me that that gold's moves would be expressed very strongly, kind of across all currencies. And frankly, I think the evidence suggests that's the case.
Yeah. All right, Louis, really good conversation once more. We got to leave it there for now. I know we'll continue it. Louis Johnson, co-CIO at Capital Wealth Advisors, talking some gold with us.